Hello all. There is a topic which is very much in news in economic survey, in budget, and it is also a previous question of UPSC 2020 prelims question, which is called as interest coverage ratio. So this interest coverage ratio, actually it comes under the subject of commerce, but which is also applied into the economy. So this interest coverage ratio will explain us this interest coverage ratio. Understanding of interest coverage ratio will make us to understand how the bank will calculate, how an entity will calculate whether if I lend the money to that particular firm, whether they will be in a position to pay back the amount. So interest coverage ratio is a parameter, is a yardstick, is a measurement which tells that when we calculate the interest coverage ratio of the firm, so with respect to the interest coverage ratio value, we can come to the conclusion that yes, the interest coverage ratio of that firm is high, so they will be paying us the loan, so there is no risk in giving loan to them. If interest coverage ratio is less, so there is an apprehension to the bank, as their interest coverage ratio is less, they will be not in a position to pay back the loan. So based upon this interest coverage ratio, the banks will be calculating while giving corporate loans. The big institutional financial institutions will be calculating with respect to the infrastructure projects, with respect to the corporate companies, whether to give the loans or not. So interest coverage ratio is a parameter. How? I will be explaining it through an example. This is the information which I explained you. With an example I will be explaining you. Just follow me. See, for example, the sales happened is 10,000 rupees sales happened. So 5,000 rupees went for raw material, 5,000 rupees went for the raw material, and after selling it I got 10,000 rupees, and the total sale gross profit, overall profit which I got, means after the investment, after the raw materials which I buy and the output which I got, when I sell the output for 10,000 and the gross profit which I am getting is 5,000 rupees. So operating expenses will be there, maintenance will be there. So for that operating expenses I will remove another 1,000 rupees. So how much it is left? 4,000 rupees. Why? Because operating expenses we cannot avoid. Depreciation. What is depreciation? Means on the firm I put investment some 3 years ago, now it is giving me the output, now it is giving me the product, so there will be depreciation of my amount. So that also I should calculate. 10,000 I will debit. Why? Because it is also, for example, at that time it was 10,000, now the value of the same 10,000 is equivalent to 13,000, so that is also an amount. So depreciation 10,000. If I take the loan, so see, big firm, a corporate firm, compulsory they will go for loans. Interest on loan is 1,000 rupees. Then what happened? Profit before the tax, the amount which I am getting is 20,000. Profit before the tax, without calculating the tax, the profit which is there is 2,000. So I will remove the tax at 50%, like corporate tax, GST, etc., all the tax. 50% I will remove profit before the tax. So 1,000 rupees I got. Finally, in my pocket, in the company's profit after tax, profit of everything is 1,000 rupees. 1,000 rupees is final calculation. Interest coverage ratio means, what is that? Means profit before depreciation, profit before depreciation, before interest paid, before tax paid. So profit is 1,000 rupees, depreciation is 1,000 rupees, interest paid on loans is 1,000 rupees, taxes is 1,000 rupees, overall 4,000 rupees. Just other expenses I removed. Interest on loan, how much? 1,000 rupees it is going. So interest coverage ratio formula will be profit before depreciation, interest on loans and tax is 4,000. Interest on loan is 1,000. Interest on loan is 1,000. So how much is the ratio? How much is the ratio? 4 times. So if the interest is 1,000 and the profit before depreciation, interest on loans and tax is 1,000, when I divide it I am getting 4,000. 4 times. If you see, If you see, if the interest is more, so if I take it is 4,000 and the tax is also more and the depreciation is low, then what will happen? The number of times will be reduced. So interest coverage ratio means how much is the percentage of amount which is left with the firms. How much is the percentage of amount which is left with the firms so that they can pay the loans, they can pay the interest to the banking sector. So if this interest coverage ratio is more, it means that yes, they have the capacity to pay back the loan. On the same lines, UPSC asked the question. See here, 2020 UPSC prelims question. What is the importance of the term interest coverage ratio of a firm in India? First one, it helps in understanding the present risk of a firm that a bank is going to give loan. Yes. If the interest coverage ratio is less, then what will happen? Oh, risk is more. If interest coverage ratio is more, risk will not be more. Why? Because they will be having the capacity to pay back the loan. Yes. It helps in evaluating the emerging risk of a firm that a bank is going to give loan. Yes. How much risk the bank is having is also studied by this interest coverage ratio. True. The higher a borrowing firm's level of interest coverage ratio, the worse its ability to service its debt. If interest coverage ratio is more, worse is its ability to service. Means worst is the ability to pay back the loan. No. If the interest coverage ratio is more, then its ability to pay back the loan will be more. According to the calculation PBDIT by interest on taxes, interest on loans. So if the percentage is more, if the interest coverage ratio is more, then their capacity to pay back the loan is more. So the answer is 192. So this interest coverage ratio is very much in the news in economic survey, budget, elsewhere. So thank you. Please subscribe to our channel. Have a good day.